many of us, we know about MSCI. We use MSCI indexes in our teaching and in our research and are familiar with MSCI. But I'm sure there's some people who are not familiar, and we're not familiar with everything that MSCI does. So let me start off by asking you, please tell us a little bit about MSCI, your company.
Well, thank you, Rina, for being here with you. And again, I wish I were there with you in person as well, but this is a phenomenal opportunity to be with everyone. So the mission of MSCI has not changed much since I created the company some 26 years ago, from a number of product lines that already existed. And that is to help investors build better portfolios for a better world. As all of us know, investments are made up of three ingredients: the return, the risk, and the art of combining risk and return together. So a lot of what we do at MSCI as the largest provider of tools to the investment industry is to help people understand performance of portfolios, to help them understand risk, and then to do portfolio construction or asset allocation on a global scale, and also on multiple asset classes, pretty much everywhere around the world. So that is a lot of what we do. Clearly, we're well known for the components of that. We're well known for our equity indices, around the world, for our Barra risk models for equity, for example, for our multi-asset class risk under RiskMetrics, and the like. But the overall components are just those, are ingredients. The overall mission is to put it all together to help people build those better portfolios. A couple of last things is we have about 8,000 investment institutional clients in 90 countries. And we also have about 4,500 employees in some 25 countries. So we're really a true global company from that perspective. And our clients are the largest asset owners, such as pension funds, sovereign wealth funds, the largest asset managers of the world, hedge funds, banks, exchanges, broker-dealers. It goes along the whole gamut of people that are in the capital markets of the world.
So, Henry, building up on that, you made a significant acquisition recently with the Real Capital Analytics, or RCA. Could you tell us a little bit about what that's all about?
Yeah, so we have built over the last, as I said, 25 years or so, what I would call, Rina, the MSCI of the public asset classes. Right. Trying to understand performance and risk in public equity, public bonds, derivatives, listed derivatives and the like. And we are now intent on building the MSCI of the private asset classes, such as private equity, private debt, real estate, and infrastructure. So we already have a growing business in core real estate data, information, indices, of course, and performance attribution services. And this acquisition of Real Capital Analytics, it was to complement the real estate offerings that we have. Real Capital Analytics is the largest provider in the world of transaction information for any kind of real estate for investors, right? Not individuals, but for investors, institutional investors around the world. And it has a database of about $20 trillion worth of transactions going back about 20 or so years. So combining what we already do in core real estate with information, market information, indices, and performance analytics, we're combining it now with transaction information and transaction analytics. And therefore we have become the largest provider of data and analytics for the global investment property industry or real estate, commercial real estate industry.
Yeah. So in some ways, you said your mission hasn't changed that much, and but you made this acquisition. So as you think about the future, as you think about the next 10, 20 years, where do you see the growth opportunities for MSCI? Where do you see changes happening, and what are market participants looking for from MSCI?
So the biggest opportunities for us, in addition to what we currently do in public equities, we're a very large provider of public equity investment tools, such as equity indices, equity risk models, equity equity trading models, and so on and so forth. In addition to that, and we also have a very large business in multi-asset class risk and performance, meaning putting the total portfolio, equities, fixed income, and everything, together. In addition to a lot of that, the biggest opportunities that we see are in expanding in fixed income, creating fixed income indices, fixed income performance attribution, fixed income risk management, fixed income portfolio construction, everything in the fixed income asset class. We also see major expansion in private asset classes, private equity, private debt, private real estate, and the like. That's another major area. And for sure on ESG and climate, right? So we are extremely focused on becoming the largest provider of climate tools to the global investment industry. We already have a very significant leadership position in ESG tools in general, in governance and social and all forms of environmental data models and tools. But this is also, climate is its own, area that we're looking to do, and we'll do that, in many ways. That's a little bit along the product line, along the client lines, the client segment line. We're already fairly big with pension funds, with long-only asset managers, hedge funds, banks. So the growth area for us are in wealth management, which is one of the largest growing parts of the investment industry, insurance companies, given a lot of our penetration in fixed income, and one of our newer segments is companies, corporations, corporates around the world. And the reason is because a lot of those companies need a lot of ESG information and a lot of climate data and information to deal with the climate challenge that they have.
Yeah. So I want to build on the ESG part, right? As you said, this is a growth area for you, and MSCI is the largest provider of ESG ratings in the world. You've actually said publicly that something like 10 years from now, ESG investing will simply be called investing. Can you expand on that? What do you mean by that?
Yeah, so what that means is that ESG investing will be completely integrated in the mainstream of investing. You will not be able to look at any investment without a dimension of ESG, a dimension of what is the right governance of the company or the sovereign entity or the municipality that you're investing in. What are their policies with respect to how they do their work, meaning the employment of people, and is it diverse, not diverse? Do they have a good working environment? Do they have good policies about that, etc.? And thirdly, for sure, what kind of environmental policies do they have? What kind of environmental footprint are they creating, especially carbon emissions and things like that? There is a new phase of capitalism that is evolving. This is not about socialism, and it's not about other things. This is about the evolution of capitalism in a highly integrated, highly interconnected, highly inter everything, right? Of the world. The form of capitalism or free enterprise system that it will be emerged is one in which this dependence on one another in countries and supply chains and people and all of that needs to have this layer of social justice, needs to have this layer of governance for the benefit of the population of those countries, and for sure, this layer of control of the emissions in the environment. So, in the old days, when capitalism was invented back in the 1800s, societies were pretty dispersed. You didn't know much what was going on between countries or people. We now know exactly what's going on among all of us. So that's the new phase of capitalism. And that's why ESG will become so critical to every investment that we make. The other thing that I would say, Rina, this is not just a trend in the investing industry. This is a trend in every other organization in society, whether it's a government, a university, an academic institution, or a religious institution. All organizations in society are being held accountable to the benefit of society in a way that is much larger than it was ever before. Accountable in their governance, accountable in their social policies or human capital policies, and for sure accountable in their environmental policies.
Yeah. So, Henry, a lot of people in the room and on Zoom, we're doing ESG related research, right? And I would say academia has done a lot of research on the G, the governance, and there's a lot more attention being paid to the E and the S, the environmental issues, the social issues. And we're a little bit challenged, we're a little bit confused about, there are a lot of ESG ratings out there, and which ones matter, how to think about different ratings, and the correlation tends to be low between ratings. How do you think about all the different ratings that are available? And now, as you said, you're expanding with companies, the issuers, in addition to investors. And as researchers, we are trying to examine these issues from both perspectives.
It's a great question, Rina, and something that I've spoken quite openly about. ESG ratings are not credit ratings. So when you think about credit ratings, they're largely, largely one-dimensional. What is the leverage of the company? What are the cash flows of the company? Can it pay its debt, and so on and so forth? So it's relatively contained in a few factors or a few variables. Now, ESG ratings are ratings that are extremely multifaceted, multivariable. You have clearly the governance part, and there are a lot of different factors in governance, the pay of the CEO, the form of the independence of the board, and so on and so forth. Then you have the variables of social issues, which is immense. Do you have a good working environment? How diverse are you? And so on and so forth. And then obviously the variables on the environment, in terms of water conservation and carbon emissions, and a large number of variables. So different rating agencies will weigh those factors differently. So their views are going to be, maybe one rating agency will think that governance is more important than that company. Another rating agency will feel that the human capital is more important on a relative basis. Somebody else will say, will put a huge weight on carbon emissions, say 90%. Another rating agency may say carbon emission is 70% of the weight, but governance and social issues are 30% of the weight. So that's going to lead to different opinions. Ratings are opinions, going to lead to different opinions about the company. Now, ultimately, a lot of the academic research that needs to be done is trying to understand the effect on the performance of those entities, by various factors. What is the source of risk and return for the social, the various forms of social factor? What is the risk and return for the governance factor and the like? And, maybe over time, there will be a little less variability in the ratings, but for sure, it's not going to be like the credit ratings, which are a lot more one-dimensional than ESG.
Yeah, I hope we in academia will be able to address some of these issues that will help both the private sector, but also help policymakers. And so talking about policymakers and regulators really all around the world, there's so much focus on what disclosure should be required about environmental issues, about climate issues, about social issues. And in the US, we're still looking for some clarity on these issues. What are your thoughts on this? And what does it mean for firms like MSCI?
Yeah, so we make a distinct separation between the opinion or the ratings and the data, the disclosure of the data. In a free world, you want to have different opinions. So you want to have different ratings of companies and see which one is the one that is best fitted to what you believe are the factors that are affecting the performance of the company. But what we do need is quantity and quality of disclosures of companies along the lines that I was mentioning before. So how many women do you have in your different ranks of the company? At what levels? How many underrepresented minorities do you have, for example? What are your carbon emissions? Where are your facilities located? What are the carbon emissions of your suppliers? The disclosure about your pay and how is that correlated to the creation of value and the like. So a lot more disclosure, especially in the climate area. There is already plenty of disclosure requirements on governance, in companies. There are not as many disclosure requirements on the social issues, for sure, and there are very little requirements on the environmental, particularly climate, carbon emissions part. Some companies have voluntarily, done that, but the gap is enormous. So we need a lot more data, and it's for people like us, for sure, but also for us to provide that data to investors around the world, so investors can make judgments as to how much they want to invest in a particular company or not invest.
Yeah. So talking about climate, MSCI has made several high-profile climate announcements. But what role can your firm and other firms like you play in reducing greenhouse emissions? And how does MSCI influence what's happening out there?
Yeah, so MSCI, another way of thinking about MSCI, Rina, is like a market infrastructure company, an investment, but probably better yet, an investment infrastructure company. So a lot of what we do lubricates the investment process, facilitates it, facilitates the investment process. And the more we do it well, the more that investment process becomes more efficient and more scalable. And we for sure know how important that the global investment industry is to society, because it is the means to take savings and turn it into productive investments for economic growth, and prosperity. So a lot of what we do is very important, and therefore we are an intermediary of being able to take massive amounts of data that we get from a lot of different sources and turn them into intelligence and turn them into models and turn them into investment tools to give it to global investors around the world. So in the topic of climate, for example, we have a huge amount to add to this. It's a very opaque process right now. It's very early days. There's not a lot of data. There are not a lot of models, that are forward-looking to understand the carbon emission trajectory of companies and how that can change and what effect they will have on global temperatures and the like. So the role that we play is absolutely critical in lubricating the investment process, which will lead to a better asset allocation, will lead to better pricing of financial assets and other assets.
So earlier we were talking about you're going to be going to Glasgow, Scotland pretty soon for the UN conference. What are your expectations there? What should investors expect coming out of that conference?
Well, this conference, COP26, is a pivotal one. The last one 6 years ago was COP21, which was in Paris, even though it's 5 years, it's 21 to 26 is 5 years, but we missed obviously a conference last year because of the pandemic, so COP26. And it's got a lot of very, very critical implications. First of all, at COP21 in Paris, or the Paris Agreement, the governments agreed that every 5 years they were going to recommit their net zero pledges. So this is the year in which that recommitment needs to happen. That's why you hear governments around the world, declaring what their pledges are in terms of net zero and in what time frame and the like. So that's going to be very important in this conference. Monday, November 1st, is where the world leaders sit there and they're going to spend a few days negotiating as to what the pledges ought to be country by country. So that's that there is a lot of expectation that is going to be a lot better, a lot more reductions in carbon emissions than took place back in 2015, I should say, 2015 in Paris. So then that's one thing. The second thing that this is a COP conference that it is very devoted to capital, in addition to the governments and the pledges. In my view, the 4 pillars of climate control are one is energy, for sure. Second one is capital. The third is technology, and fourth is policy. Policymakers. So this is one that is focused on capital. The big day there is Wednesday, November 3rd, and a lot of us are going there because of that, because of the capital, and there are banks and asset owners and asset managers and insurance companies and the like that are making pledges and creating alliances among their like. So there is a bank alliance, there is an asset owner alliance, an asset manager alliance that are working together to create reductions in net carbon emissions of their portfolios, a loan portfolio or an investment portfolio. So we at MSCI are part of the Service Providers Alliance. So we want to see how much progress we make in mobilizing the capital markets of the world to address this problem of decarbonizing their portfolios, to put pressure, obviously, on the companies and the other issuers. The third goal that we'd like to see there is mandated disclosures, by governments. We've been lobbying governments pretty hard in the lead up to COP26 to get mandated disclosures along the lines of what we were talking about earlier. Now, I hope that also this conference addresses the issue of the $100 billion of money that it was promised in 2015 at the Paris conference, of aid from the developed countries to the emerging countries. The emerging countries didn't go through the industrialization process. They're no longer, they're still going through that, and therefore they need help to continue to industrialize, but still not create so many emissions. So we're hoping that is the case. These conferences are difficult because you got 200 countries trying to get together and agree on something. And Boris Johnson, I think a week or so ago, issued a statement that the progress so far is not great, and that every country and every company and every capital institution needs to step up and do its best to try to get some results, and the world needs it badly.
Mm-hmm. Great. There are tons of questions coming up in the chat. Before I turn to those questions, let me just ask one more question on a slightly different topic. So China is pretty important for MSCI's business. And can you talk a little bit about what you're doing in China? What's the outlook for China? And what's going on with the U.S.-China economic relations? And how do you see that?
Well, as you know, Rina, China has the second largest equity markets of the world and the second largest bond market of the world. So for any investor or any participant in the capital markets, you cannot say that China doesn't matter, that China is not important. It is hugely important. Obviously, it has the second largest economy in the world and growing pretty fast, even at the lower rates this year. So that's one thing. Secondly, China is already heavily integrated into the global economy at all levels and in all aspects of the economy. So the talk about decoupling the US and China, or decoupling the West with China, is a complete myth. And it's if you were to ask anybody, I don't even know how somebody will go about doing that, right? Given the high levels of integration, if you just take trade, even in the context of the trade war between the two countries, just in August alone, the two-way trade between the US and China was $54 billion, right? So this is not, most people look at the Cold War, back in the last last century with the Soviet Union and the US and other countries, and compare it to China. In those days, there was very, very, very little interaction between the Soviet Union and the US or the West. There was no social interaction, no economic, no trade, nothing, right? It was extremely limited. This is completely different. So therefore, the relationship between China and the US will have to be multidimensional. There will be an economic one, there will be a human rights one, there will be a political one, a geopolitical one, there will be a financial one, and all of that. And in some areas there will be climate change, relationship. In some areas there will be a lot of friction and adversarial situations like military, and sovereignty issues like Taiwan and the like. And in other areas, you will have to be a lot of cooperation, like in trade and in finance and in investments. So I will say that Wall Street or the capital markets of the world. Somebody recently told me that everyone knows that there are a lot of geopolitical tensions going on between the US and China, except for Wall Street. Because Wall Street is going full speed ahead in setting up investment firms and mutual fund firms and banks and insurance companies and everything, in China, as if there are no frictions or restrictions.
Yeah. I'm going to take up a question from chat here. And the question is, are MSCI country classifications as emerging, developed, frontier, are they due for a major rehaul with the shifts in the economic power and performance that you were kind of alluding to?
We have looked at that issue pretty frequently, at MSCI. As you know, we have a three-tier classification: developed markets, emerging markets, and frontier markets, and have looked at that issue. Should there be just one string of countries in a spectrum, and do away with the classification or not? It is very difficult to do that, and the investment industry is very used to the division, similar to the investment grade versus non-investment grade. Is very used to that, and also it presents a problem at the border, right? Think of it, the top end of emerging markets versus the bottom end of developed markets. So in that sort of buffer area, similarly, the top end of frontier markets versus the bottom end of emerging markets. But I think that unfortunately, a lot of emerging markets haven't really emerged, haven't really completely turned into developed markets. There have been a few exceptions to that we have promoted, in the indices. So I think it's going to be hard, to do away with this classification.
Uh-huh. Related to indexes, there's another question here, and the question is: has competition from CRSP impacted you?
Well, there is competition from a number of index providers, around the world. The market has opened up a lot more. We don't see as much competition from CRSP, but we see significant competition from others. We continue to be a leader and gain market share, interestingly, from a very high level of market share, because of the high quality of data, the high quality of our indices, and especially because of the pace of our innovations. So we are basically going, in addition to the market cap indices that we created, which are basically measurements of markets, we are now building a whole generation of what we call investment thesis indices or non-market cap indices, which have a demand component. They have an investment bias, such as ESG, climate, factors like momentum, like volatility, like quality. We're now building thematic indices, if indices in clean energy, in biotech, and the like. So I think that this business of creating indices is exploding. Is really exploding because these are bases of portfolios, and everyone wants a basis of a portfolio that they can build on top. And I think the biggest growth area ultimately will be what is called direct indexing, which is the ability to create a personalized index for an individual investor, which is put in a separately managed account by a wealth manager. That's going to be the mother of all inventions, right?
Yeah. So are you thinking about anything in terms of digital assets and indexes related to digital assets? Is that the future?
Well, that's one of the darlings of the media and darlings of certain investors around the world, cryptocurrencies, and obviously the cryptocurrency exchanges and the like, right? We have done a meaningful amount of research there to try to see how we can create an index of cryptocurrencies that will then be the form of an ETF, for example. I mean, this week there was an ETF on cryptocurrencies based on futures that was launched, and it's gathered a lot of assets, this week. So we're doing some work about that. It's not as easy to create the index because you got to have the sources of the prices, the sources of a lot of different things that are underlying indices that are kind of technical in nature. The area that we are very intrigued by, is to look at cryptocurrencies in the context of carbon emissions. Because there are some, cryptocurrencies that are huge emitters of carbon dioxide or their equivalents. And then that will create, a big problem in the world. The other area clearly that we're focused on is decentralized finance and blockchain and the effects of all of that can have in the banking system and the financial services industry. And the last part that we're looking at is clearly the central bank digital currencies. China obviously is the leader in that at this point, and the European Central Bank is doing a lot of work on that as well, and the Fed just started doing work.
Yeah. So Henry, there are a lot of questions here that are sort of related to technology and AI and machine learning. And you talked about how MSCI is really doing a lot of innovative work. So I'm going to put several of these questions together and just ask broadly, how is machine learning or AI being used by MSCI, but also by your clients?
Well, yeah, it's a huge area. I mean, MSCI is a technology company as well as a data and a model company. If you were to think about a lot of our people are either technologists or modelers or data people. In fact, more than half of our employees are technology people. And therefore we use a lot of those technologies to do three things: to better collect data in a way that is highly scalable. So for an example, there is ESG data or climate data. If we didn't have a lot of these technologies, we will need to have thousands and thousands of people collecting data. But what we do is that we build machine learning models that go and look at the data and try to decipher it and try to analyze it and try to summarize it so that a human can then take a look at the data and see how we can use it. That would be one example. The second area where we use AI and machine learning and another natural language processing and all of that is in our production environment. Inside MSCI is a giant data factory. Creating our own data for indices, for risk models and all of that. But we also have, we also are one of the largest providers of risk management processing, right? Risk management system and processing for the global, investment industry. So there's a lot of processing of people's portfolios to give them the statistics as to their risk and their performance and all of that. So we use AI to be able to control quality and look at aberrations and look at things that are not right. And without that, we will need to put a lot more people. The third part of where we use this is in the distribution of the data, distributing the data through third party or to our clients. Now, for sure, a lot of the investment institutions and banking institutions of the world are looking at all these technologies to discern trends, to pick stocks, for example, to pick credit ratings for lending, will be another example, and the like. And we're working with many of those clients to enhance those capabilities.
A related question that's coming in chat is, what kind of changes do you envision in your ESG ratings and your ESG database? How has that evolved over time, and how will it continue to evolve?
So basically, there's been a trajectory. The ESG started as a screening tool, being able to eliminate all the tobacco companies, eliminate all the cluster bond companies in the world, and the SINT companies and the like, so that sort of exclusions, right? Screening or exclusions. Then the second evolution, after that is ratings. So we began to create ratings. The third is with the ratings we create indices, right? Equity indices, fixed income indices. The next evolution that we're at right now is to put ESG and climate as risk factors in risk and performance models, right? Of all type. So that's kind of where we are at now. That's one dimension. The other dimension that we're working pretty hard on is our clients not only want to see kind of the end result and the tools, they want to see the underlying data, the underlying information, because maybe they reach a different conclusion that we reach about the rating, for example. So we're working on putting a lot of technology to organize the data appropriately and expose that data to our clients. So now in terms of specific areas, the areas that we have the highest demand for right now are clearly climate data, but social data. Obviously, it's no surprise given the events last year and some of the social justice issues around the world that investors are looking to understand what companies are not going to do well or what companies will be better positioned with respect to their human capital.
Well, another question here is, what regulatory changes do you find to be most constraining? And what regulation do you want to see happening? You already talked about some of this before, but from a regulatory perspective, what is constraining? What needs to change? What needs to happen?
Well, that's a great question, and sometimes it's a difficult one because I am typically a free market person. I believe in the free markets. I believe, obviously, in the policing of governments and nation states of the markets. But I am very concerned when governments want to run markets or dictate what people should do in markets. That never ends well because the allocation of capital and the pricing of assets gets distorted, by government intervention or regulatory intervention. The second thing is that we love competition. It makes us better, makes people choices and the like. And the more regulatory frameworks you put into industries, the lesser the competition is going to be, because the incumbents like ourselves are going to have a major advantage of dealing with the regulations that a startup cannot achieve. So I think that one is clearly in the area of disclosures. That should be an appropriate area for regulations. There's been some regulations on benchmarks coming out of LIBOR. It was funny because when I went to the regulators in Europe, they said they wanted to regulate us, and I said, why? Well, because of LIBOR. And I said, what do we have to do with LIBOR? And I said, well, LIBOR is a benchmark and you're a benchmark too, so therefore we have to regulate you. And that kind of mentality gets you in trouble. But it turned out to be light regulation that we're easily complying with. but it is creating barriers to entry for others, to come into what we do. So there's certain parts of regulations, and certain part of government aid that is important. For example, the creation of carbon markets. I think the governments around the world can be very helpful in encouraging banks and investment banks and other institutions to create carbon markets, carbon offset markets. There are standards that need to be, for example, created, such as what is a carbon offset and what should not be a carbon offset. So I think governments should be in the business of creating standards, creating information, creating disclosures, policing bad actors, but they cannot be the markets themselves, right?
So related to regulatory intervention, government intervention, there's a question here. So you had to remove some Chinese companies from your indexes because of action taken by the administration earlier this year. What impact did that have?
Well, it does have an impact on people's portfolios. So if you forget the index is just a measure of opportunity sets that investors have, around the world. So if you begin to create a process by which you start, putting legislation to eliminate companies, you're eliminating potential great investment opportunities for American citizens, and pensioners and the like. So, and some of that was for military reasons, some of that was political reasons, geopolitical reasons, and the like. And we spoke around that time. We're going to comply with every regulation and every law that every country gives us. But we need to be very careful that if there was a trade war, and there may continue to be, we don't want to have a finance war. We don't want to have a capital war. In the U.S., we have to be careful that the Chinese government owns over $1 trillion of our sovereign bonds. And if we say, well, the Chinese can buy our sovereign bonds, but we're going to prevent our American citizens, American pensions from buying Chinese bonds or Chinese equities, it's going to be a tit for tat. So you have to be careful, obviously, what you're trying to do here, and the like. Now, if there is a company that has a human rights issue, that needs to be called out, that may be important. But I think this trend of using the investment industry or in our case indices to try to redirect capital and prohibit capital from going places is a dangerous trend.
So Henry, let me ask a last question that is very relevant for this audience, and you touched on it a little bit earlier. But so the question is, what kind of research can we academics do that would be helpful to industry, to companies like MSCI, and to policymakers?
Oh, quite a lot, quite a lot. I mean, we touch upon the issue of ESG and climate. So in the case of ESG, literally the number one question that an asset allocator, such as a university endowment or a pension fund or even an asset manager, asks is, why should I be investing in ESG since it's going to give me lower returns? And there has been a meaningful amount of research in this area that has gradually demonstrated that a portfolio made of high ESG companies has lower cost of capital, has higher performance and outperformance and the like. But more research in that area will be important to distill the myth that putting money into sustainable companies is about giving up returns. So that's one area. The second area that I did mention, obviously, was the concept of distilling the factors, the variables in ESG, and try to ascertain what is the correlation or the causality of those variables to the performance of the company, to the short-term and medium-term and long-term performance of the company. Another area, not only in finance, but it will be, if you think about what is great research would be a company that is very good in employing women and promoting women and supporting women and encouraging women. How does that outdistance that company versus another one that doesn't? Because a lot of people think, a lot of people think that employing women is just like a social cost. I said, no, there is a big business benefit of employing, the best talent that you have, whether it is, Latinos like myself or African Americans or anybody, but it needs to be quantified, in terms of what is the performance associated with those, those kinds of companies. That's another thing. In the area of climate, it's an incredibly rich environment on research about the nature of carbon emissions, the trajectory of those carbon emissions, the pledges that companies are making, and whether those pledges are having any, do they have details, and are they having any effect on the performance of those companies? Are they having any effect on the risk of the company, on the performance of the company, and so on and so forth. So there is really an extremely rich environment. I think that in the capital markets and in finance, and I typically have focused on the investment industry. I can go through a lot of examples in the finance industry, meaning extending loans, for example. By finance, I normally mean banks extending loans, right? For example, or insurance companies, having an insurance policy and creating an annuity or a variable annuity or things like that. We also operate in that area. So you could. I think the world today is extremely rich, really rich in opportunities for researchers, in finance and investments to create a large variety of research projects in so many different areas. Another one obviously is private equity, right? Everyone talks about private equity versus the performance of public equities. So what is the outperformance from? Where is that coming from? Is that because of the leverage that is put in some of these companies, or especially the LBOs, or is it because the value add, the management that they put in place? So the same thing on private credit. There is an explosion of investments in private debt and in private credit. What is the comparison to public debt and public credit? So I think the world is so rich because it's so global now. There are so many asset classes, so many currencies that you can examine, and so many issues, opportunities and risks, like ESG and climate and factors and everything. I started my life as an academician when I was in the PhD program in economics and finance at Princeton, and I remember those days, and I can tell you I wish I were back being an academician now, because it will be a very rich environment for me to do some great research.
Henry, this has been absolutely fantastic. Your insights have been terrific. You've given us a lot of food for thought. We are so honored to have you speak to us today. So thank you very much. And you're part of the FMA family now.
I am, and I welcome that, and I thank you for that.